Wall Street rallies as the latest CPI report shows a slight cooling in U.S. consumer inflation for April. Let's unpack the details. Welcome back, everyone. Let's take a look at the just released CPI report. Chris and Thomas, if you would, quickly summarize the report for us and maybe the significance for the average consumer and investor today.
Well, right. Chris may disagree, but my take on the report is that it aligns with expectations. It also aligns with the idea of receding inflation and the FOMC rate cuts. It may not be cool enough, quick enough for them to cut over the summer, but I think that this plays into the Goldilocks scenario, and the Fed is on track for rate cuts, all things being equal and no other major changes happening. I think the implications for the consumer and the investor are kind of different. On the consumer end, inflation is cooling and it's not accelerating fast enough for the Fed to increase rates, but prices are still rising and they're still at record highs. So there is that elephant in the room to be addressed. As far as the investor goes, you can look at the market right now. It's setting a new all-time high. So I think this is an all clear for bulls, at least for the next few weeks.
Yeah, I don't know if my take is different from Thomas. I guess it's just a little different in the fact that if we always remember that CPI is a lagging indicator. So yesterday we were chatting and I mentioned that the PPI, the headline PPI number was bad. But then they noticed that, then they remarked that the March PPI number had been revised lower. And I said, well, that might mean that CPI comes in cooler than expected, and that's basically what happened today. Now, the question is, where does CPI go next month? And I think that's really the story here. I think good news is CPI didn't get hotter. Bad news is I think we're probably stuck in this range between 3, 3.5, 3 3/4. And I just don't know if there's going to be enough movement there that would give the Fed an all clear signal to lower rates. But certainly today, the markets are reacting to it positively. But consumers, they don't feel any different because, again, 3% is higher than what historically was the Fed's average or the Fed's preferred target of 2%. And that's just, the consumers are still feeling it.
Want to keep your finger on the pulse of the market? Text the word YouTube to 68285. That's 68285 and get free breaking news alerts from MarketBeat for the stocks that matter most to you. Don't miss out on crucial updates. Stay informed and stay ahead. Now let's look a little deeper into some of the other details in this report here. So April showed no growth in retail sales. How does consumer reluctance to spend impact the broader economy here? And what could this signal?
Well, right. So retail sales were flat compared to last month, so no acceleration from last month. Still up 3% compared to last year. 3% is less than inflation. So at face value, we're looking at retail sales actually falling on a volume basis, right, being offset by higher prices. So right now, we're still looking at an inflated economy. So we're still going to see some GDP growth because of inflation. And until that changes, I think that the Fed is not going to be cutting rates too quickly.
Yeah, I heard the same comment that Thomas was just making yesterday. I don't remember who the analyst was, but she remarked that if you see retail sales up 3% year over year, you think, oh, that's good. But then you have to remember that that's not an inflation adjusted statistic. So when you figure if CPI is coming in at 3.4, retail sales are at 3, like Thomas said, retail sales are actually negative, and it's been going on that way for a little while yet.
Right. It's really like it's a meh kind of read. It can be funny, the direction. I mean, it's not good or bad. It just is what it is.
Yeah.
Retail sales volume is kind of flat. Prices are up because of inflation. Inflation is driving the economy, and that's driving the market. So
now, given the Federal Reserve's current stance and the fact that we're experiencing the highest interest rates in 23 years, what are the potential scenarios that we might see in the near future? Can we anticipate any rate cuts?
Well, so the market is for sure anticipating a rate cut. That is absolutely being priced into the market right now. And as we've been discussing, we talk about it all the time off air. when or if the Fed will start cutting rates, and there's a definite possibility that they won't cut rates. I mean, the thing that we need to keep remembering is that the Fed normalized interest rates. Normalized means we're in a period of normalcy, right? So in that scenario, it's unlikely to get a rate cut without some kind of economic deterioration that we really haven't seen yet.
Yeah, in fact, Thomas, I just saw something since the CPI came out that all of a sudden now some analysts are now changing their expectations. Now they're expecting 2 rate cuts sometime in 2024, which just goes to show you that we've become just such a prisoner of the moment market. Now the CPI goes down just a little bit, and now everybody's, happy days. We're going to lower interest rates now, not once but twice before the end of the year.
Right.
Whereas earlier this week we were thinking that we might not get any. I'm still in agreement with what Thomas just said. I think the data shows that we won't have a cut before the end of the year. I think the Federal Reserve wants to cut before the end of the year. But I don't think that cut's coming before September at the earliest.
Right. And always remember too, this economy is kind of chomping at the bit. It's waiting for the Fed to cut rates, it's waiting to start reaccelerating. As soon as they do that, demand will pick up. That will reaccelerate inflation. So the Fed, I mean, they're walking this tightrope, right? It looks like we have this glide path into a soft landing, and it could keep happening. But I think right now they need to keep the brakes on, and I don't expect them to do much rate cutting this year at all.
Right.
So you touched on this a little bit here, but let's look a little bit further. Looking at the persistence of inflation and the economic strategies that are currently in place, what are your long-term forecasts for the U.S. economy going forward?
I think that a lot's going to depend on where monetary policy and government policy is in the new year. If we keep down a path of tighter regulations, a lot of stimulus coming from government spending, I think it's going to be really tough to see inflation getting back down towards that 2% target, which means I think you're just going to continue to see the market chopping along as it's doing now. If you start seeing policies that shift more towards less regulation, unleashing business a little bit more, I think you'll probably see you'll see accelerated growth. You might actually then see, as Thomas was pointing out, you might also see inflation surge a little bit, but at that point, then we might actually be having growth that can keep up with that inflation.
Yeah, I'm kind of looking at a range-bound market right now that's just kind of grinding sideways near these all-time highs that were set by the pandemic bubble, right? I'm looking at a couple of years of sluggish, tepid to maybe no growth. I mean, 1 or 2%, one up year, one down year, as the market and the economy digests all these gains we made over the last few years and becomes normalized to the current interest rate policy.
All right. Are there any final words or knowledge that you would offer to investors as they navigate these current conditions?
Keep an eye on your favorite stocks and buy them on the dips.
Absolutely. And look for companies that, that have lots of cash, that are you're never going to have to worry about the fact of them being able to, if they're a dividend paying stock, they're going to be able to continue to pay their dividends, that they've got a lot of cash in reserve to weather whatever is going to come out of these things. If you're going to be in some of the speculative stuff, if you're going to be into some of the young companies, the early companies, just realize, like Thomas said, it's going to be a choppy 2 years. And there's no reason, I should say, to worry about making a big accumulation, taking a big position in those companies right now. You can just nibble at them from time to time. But really right now, it's kind of the look for the best and kind of avoid the rest.
Yes, well, if you found today's insights helpful, don't forget to subscribe and check out our additional investing news and resources right here at Market Beat. Until next time, stay tuned for more.